Hello, everyone, and welcome to today's webinar. I will take a few seconds to allow our audience to trickle in, and we'll kick things off at the top of the hour as we talk about U.S. taxes. It is tax filing season, as you can imagine. Bright Tax is busier than ever with a deadline just 6 days away. And I would imagine that's driving a lot of questions from you all as you think about the April 15th tax deadline that is on the horizon. So thank you so much for joining us today. We are going to talk about maximizing tax benefits for U.S. expats. My name is Katelynn Minott. I am the CEO at Bright Tax. I lead a team of tax professionals who specializes in serving Americans who have international circumstances when it comes to filing their U.S. taxes. So without further ado, I'm going to jump right in and share with you the agenda that we are going to be walking through in our presentation today. We will start with some essentials that you need to know about U.S. tax filing. From there, we are going to hand the mic over to the Q&A function of our webinar today, and I will be answering questions that roll through in the Q&A function of Zoom here. And then next steps, we'll also share with you what it looks like to work with Bright Tax, work with the managers on our team, and give you some insights on next steps should you decide to engage with Bright Tax for your U.S. tax filing. So we'll kick things off with U.S. tax filing essentials, all the things that you need to know as you think about tax season. And I'll start really with the basics. And the first thing you need to know is that every American who meets minimum income thresholds does have to file a U.S. tax return. And those thresholds apply to your worldwide income. So these thresholds are the exact same thresholds that apply to somebody who lives in the States. Your filing threshold does not change based on the fact that you live abroad. And when you're considering whether you have to file a U.S. tax return, you should consider all of your income, whether it be income in U.S. bank account, foreign bank account, U.S. client, foreign client, or employer, all the same. When you are a U.S. taxpayer, you need to disclose and file to report everything on your U.S. tax return. I won't walk through the numbers specifically here, but it is important to call out that the married filing separate threshold is very low. It's just $5. And this is a very common circumstance that taxpayers find themselves in when they live abroad. Many of our clients are married to non-U.S. taxpayers and as a result are using this filing status. So just $5 of bank interest or any other income can trigger the need to file a U.S. tax return, even if you don't otherwise have income. So from there, let's talk about what the thresholds look like for self-employment income and individuals who are self-employed rather than having other sources of income. The thresholds that I just shared with you are relevant, but much lower at just $400 if you have self-employment earnings during a calendar year. So be sure to file a U.S. tax return. That's the starting point for this conversation today. Note that your income is going to be classified by U.S. source income or foreign source income based on where you're sitting and earning it. So if you sit in an office outside of the US, then your income is considered to be foreign sourced. Whereas if you, the person earning your income, is based in the US, that is considered to be US source. And that will become relevant a little bit later in our conversation today as we talk about ways to save on your US tax bill. So beyond filing a U.S. tax return, there are some other requirements that are really important that you should be aware of when you're preparing the tax return and making sure you're compliant each year. One of those requirements is called an FBAR, the FBAR being a foreign bank account report that is required to file with the U.S. Treasury each year if you have $10,000 or more in accounts abroad. So if you live abroad and you have a financial account, bank account, pension account, investment account, and in total outside of the U.S. you have $10,000 or more, you should be filing an FBAR. I want to highlight that the FBAR does not drive any tax due to the IRS, but it is a form that attracts very high penalties, so it's absolutely not one that you should miss. Whenever in doubt, file the FBAR. Again, it doesn't drive any tax and it has high penalties, so that's something we do as part of the tax filing exercise for our clients. Another disclosure quite similar to the FBAR is something called the Form 8938. It is very similar in that you're reporting your bank accounts abroad, other financial assets that you have abroad. The threshold for this one is a bit higher at $50,000 for those who live in the States and $200,000 for those taxpayers who are abroad. Let's talk deadlines. The tax deadlines for Americans who are living outside of the US are a little bit different from those deadlines for those who are stateside. April 15th is the date we kind of all know well as tax day. We started out today's conversation talking about April 15th being just 6 days away. But the reality is, for somebody who lives outside of the US, the deadlines vary quite a bit. April 15th is in fact the date that you should be paying your tax bill if you want to avoid any sort of interest with the IRS. And if you live in the States, this is your tax filing deadline as well. The 15th of April is also the date that your FBAR is due, that foreign account disclosure that we just talked about. But if you live abroad as of April 15th, so if you're living outside of the States next week, then you actually have an automatic two-month extension to June 16th to file. So for our clients who live outside of the US and are having to file a US tax return, the relevant deadline for them is in fact 2 months later than the April 15th deadline. This year, it'll fall on the 16th, which I believe is a Monday. Now, if you need more time, which is very often the case because maybe your foreign tax return isn't ready yet and you need that to file, you can file an automatic extension to October 15th. We file Form 4868 to request that extension. We actually do this as a matter of procedure to take care of our clients at Bright Tax because we don't want to create the possibility for any IRS penalties that are not necessary. So October 15th is going to be the deadline that you can request an extension for filing to. And if you don't get your FBAR done by April 15th, then the IRS or the US Treasury automatically extends your FBAR filing deadline to October 15th. You don't need any action taken to extend the FBAR deadline to October 15th. So just missing April 15th is another way of requesting an extension for your FBAR. And then last but not least, we have a final stretch of final extension for those who live outside of the US. We can write a letter to the IRS and say, we're not going to be ready by the October 15th deadline. Please allow us another 2 months, and we get until December 15th as a final extension for expats. This one can be a little messy, but it is sometimes necessary. So we don't recommend it, but we can offer that as a course of action in the case that it is absolutely necessary. So moving on, is any of this news? Did you just learn that you have a US tax filing requirement, or maybe the FBAR is something that you've never heard of before? This is quite common. We hear all day long about people who have not realized that they had to file a US tax return, lived abroad for many years, maybe lived in the US and actually had accounts located outside of the US and didn't realize that they had to report them. It's very common. There's a lot of misunderstanding about what tax treaties mean, what filing thresholds are, and people sometimes get bad tax advice from professionals who don't necessarily have that intimate understanding of how international tax works. And so there are lots of procedures and ways to get caught up, some of which we'll talk about today. But it's estimated that only about 10% of the Americans living abroad are actually compliant with their tax filing requirements. So this is where something called the streamline procedure can come in. If you've not filed and you just realize you need to file something in your tax return that you haven't done before, the streamline procedure is a way to get caught up. If you're abroad, this is a penalty-free approach to compliance. If you are stateside, it's a mitigated or reduced penalty when you're amending your returns and fixing what you otherwise should have disclosed. So we, as a firm, have done thousands and thousands of streamlined procedures successfully over the last 15 years, and we are very fanatical about promoting this as approach to getting caught up because it's very effective, and it's sort of the IRS opening the front door and saying, we want you to do the right thing. Here's a penalty-free way to do so. So let's talk a little bit about filing and what it looks like to reduce double taxation on your return, especially if you're paying tax abroad and you're earning abroad. That's really important as you go through the calculation of your tax return every year to reduce your tax bill. And that's where we specialize as a firm. So the tool that I always use first when I'm prepping a return for a client, and we always talk about first when we are looking at ways to reduce double taxation, is something called the foreign tax credit. And the foreign tax credit gives you credit on your US return for whatever you've paid in income tax abroad. Sometimes that will wipe out your US tax bill altogether, especially if you are in a high tax country. European countries are a great example of this. In other cases, we can use other tools such as the Foreign Earned Income Exclusion. The Foreign Earned Income Exclusion allows expats, people living abroad or who have substantial time spent outside of the US, to exclude the first 126,000 of their income from their US tax bill. So 126,500 in earnings, whether that be wage earnings or self-employment income, can be excluded from your income, excluded from your taxable income, which then, of course, impacts your bottom line, your tax bill. The catch with this, though, it does have to be earned income. So it has to be, like I said, a wage or a self-employment income item. And it has its limitations in terms of the maximum cap of 126K, but both of these are very valuable tools and tools that we use all day long with our clients to reduce their tax bills. Which one you can use is going to depend on your circumstance. That's the answer most tax pros will give you to many tax questions. But the foreign tax credit works really well if you've paid foreign tax, but if you haven't, that's not going to be a tool that serves you well. The foreign earned income exclusion is going to be great if you fall under the income threshold of 130K approximately. If you've spent substantial time outside of the US and meet the physical presence test or what's called the bona fide residence test. But it can only be applied to earned income. So wage, salary, self-employment, etc. With somebody who has pension earnings or retirement income, investment income, those types of income categories are not going to be able to take advantage of the foreign earned income exclusion. So other tips and ways to reduce your US tax bill. File on time, pay on time. We're, of course, here to bring you information about how to file, but there's a whole world of disclosures and requirements out there when it comes to your international circumstances. So 5471 is one of those forms that people get caught off guard by. If you have a company registered outside of the US, the 5471 is going to be a disclosure that you should be aware of and thinking about filing on your tax return. Form 8865 is a foreign partnership disclosure. Again, if you have a foreign business, we should be having a conversation about what disclosures you need to file and make sure that you're avoiding penalties. Foreign trusts are another common place that people fail to disclose. And then, of course, the FBAR and the FATCA that we discussed, those disclosures in which you are filing your foreign bank account balances and reporting foreign financial assets to the IRS, simply to show them where they are and ensure that you are compliant on your US taxes. So at the end of the day, filing on time and reporting all of your foreign circumstances, in addition to any US circumstances you have, accurately is going to be your key to lowering your US tax bill, avoiding penalties, and having a smooth tax season. So that was a quick run through of all of the things that you should know as you file US taxes. And from here, we're going to shift over to the Q&A. I see that some people have begun to include questions in the Q&A feature. I would ask that rather than using the chat feature of Zoom, you use the Q&A. That way we can effectively work through all of the questions and answer them, selecting them, of course, in order of relevance to the wider group. So please go ahead and drop your questions in the Q&A area of the webinar so that we can support and answer those for you. So I will start from the top. And Darren asks, if many expats buy a smaller place in the southern states to take advantage of the 7% rule. I'm not totally sure what you're referring to here with regards to the 7% rule, but what I will kind of speak to and answer here is with regards to moving states. When you move abroad, there are state filing requirements that can come into play. And if you are leaving a state with an income tax responsibility and filing requirement, some people utilize that departure and take advantage of it strategically to reduce their US tax bill. So I'll give you an example. Let's say I live in the state of New York and I'm planning to move to Spain. It may be to my advantage to take some time and relocate within the US out of New York into a income tax-free state. So for example, Florida, Texas are two examples that might work well in, and spend some time establishing residency in those states. What you're effectively doing there is eliminating any potential state income tax that you could attract once you move abroad. So that is a strategy that we see clients use, again, to reduce their US tax bill and ensure they're not susceptible to state tax once they move abroad. All right. I live in New Zealand, and an accountant advised against self-employment, stating those earnings would be subject to 15% tax no matter how much tax you already paid overseas. How much is there a similar difference in regards to drawing a shareholder earnings? Well, I'm going to start with the first part of this question because this is a really good question about the self-employment tax. So in the US, as you file your US tax return as a self-employed individual, you are subject to income tax, and you are also potentially subject to self-employment tax if you have net earnings. The self-employment tax rate is about 15.3%. And essentially, when you move abroad, what you would be doing in a country like New Zealand is paying the US self-employment tax, as well as potentially paying into the local system of Social Security. So there is the possibility for double taxation from a self-employment perspective for somebody who's in New Zealand. The reason that exists is because there's no totalization agreement between New Zealand and the US. So another example that I'll offer is somebody who's self-employed in the UK, in the United Kingdom. There is a totalization agreement in place between the UK and the US. So somebody who's self-employed in the UK, because of the totalization agreement, doesn't actually have to pay that 15.3% tax. So for somebody who's self-employed, when we're preparing a tax return, we're going to be looking at that person's country of residency, and if they're paying into the social system there, and then, of course, evaluating whether a totalization agreement is in place to see if we can use that tool to reduce the 15.3% tax. Not paying into the US Social Security system, of course, has implications as it relates to accumulating points for eventual benefits from the Social Security system. So it's something that is important to evaluate and determine which system you pay into. The totalization agreement itself typically gives you guidance in terms of which country's system you're supposed to be paying into based on how long you intend to live there, etc. So this is a question that, while it is pointed to New Zealand, it actually is relevant to anybody who's self-employed outside of the US. The second part of this question is with regards to drawing shareholder earnings from a New Zealand-based company. So one way to avoid the self-employment tax is actually to be paid by a company instead. So in this case, if I'm in New Zealand, I could set up a company in New Zealand and then pay myself a wage. Now, that wage is not going to be subject to self-employment tax. However, as a New Zealand-based company and the owner of a New Zealand-based company, I now have to consider what's called the 5471 and reporting that 5471 on my US tax return every year. The pros and cons of that, there's the tax preparation fee associated with a foreign company and the ownership of that. If the company has net earnings, those could potentially be flowing through to your US tax return without the possibility of foreign tax credit. So setting up a company to avoid self-employment tax is a possibility. However, it should be evaluated carefully to understand the costs and the implications of both scenarios to see if that will actually bring you ultimate financial efficiency. So it's a good question, and I think it addresses two points that could be relevant to anybody in New Zealand or anywhere around the world. All right. So Lisa asks if when filing the extension for the October 15th, when that should be filed by. This is a good question because the answer depends on where you live. So Lisa, if you are in the US and you live in the US as of April 15th, then you need to be filing an extension at some point in the next 6 days. If you live outside of the US, you actually now have until June 15th to not only file your return, but also to file the extension to the October 15th deadline. So based on the answer to that question of where you reside, you will determine when the October 15th deadline extension should be filed. All right. With a non-US spouse, I plan to file German taxes jointly and US taxes separately. How would I figure out my foreign tax credit? This is a great question, and it does highlight the fact that the way that you file your foreign taxes does not necessarily parallel the way and the filing status for your US tax return. So in this case, we have German taxes being filed jointly and then US taxes filing separately. In this case, there would probably be an allocation that takes place where we look at the total income earned in Germany and then the tax that is being attracted by each partner's income, which each spouse's income in this case. So a prorated calculation basically to say this part of my German tax bill belongs to this spouse, this part belongs to the other spouse, and do that calculation to reasonably allocate German tax paid. And then what we would do is take the German tax paid related to the US spouse and take a foreign tax credit to reduce the US tax bill, eliminating double taxation effectively in this case. So this is a great question. Okay. If I inherit 300,000 euros from non-US spouse, what happens if she inherits this amount from me? So from the US perspective, inheritance is not something that would attract tax. So in general, receiving an inheritance as a US taxpayer is not going to attract tax to you. Tax at the inherit is at the estate level in the US. So in this case, there's nothing that would need to be considered. A transfer from a US spouse to a non-US spouse is a little bit different. There are limitations and thresholds that can potentially drive, and at that point, the estate tax. So that those thresholds would need to be evaluated in the case of that directional of a transfer. Okay. Why do I need to disclose money, not income, in another country if there's no tax implication? I love this question. This is a fantastic question. And the answer is actually that the IRS is, in theory, using this information of foreign bank accounts to ensure compliance when it comes to income reporting. So the parallel example is the US. So what happens in the US? You have a US bank account. The IRS, in theory, has access to understand that information and transactions in your bank account. Your bank account is linked to your Social Security number, which is in turn linked to your IRS account. Abroad, the IRS does not have that visibility, right? At least right now in all countries. It's getting closer, however. So the FATCA, the FBAR, the disclosures that we talked about, are the IRS's way of peeking into your bank accounts, just like they do here in the States, but it requires you to proactively do something, whereas when your account is based in the States, they can access that information without you. So at the end of the day, we can talk about FATCA a bit. FATCA is a regulation that drives the need for you to file the Form 8938 and disclose your balances. But not only at the individual level does it apply, but it also is now applying at the foreign bank level. So some of you may have foreign bank accounts, and some of you may have had to offer the bank your Social Security number when you open that foreign account, which is quite alarming, I'm sure, when you're going to open a UK account and all of a sudden they want your Social Security number, which is a US number. And the reason is that the IRS now has communication between their system and foreign banks, whereas foreign banks have to report the details of their American taxpayers back to the IRS in theory. So it's sort of a two-part exercise where the foreign bank is reporting in some cases, and then you are also required to report individually in other cases. Okay, so Fred asks if for retirees, the 126,000 threshold applies to investment income, pension, and Social Security. Unfortunately, it does not. So the foreign earned income exclusion that we talked about does not apply to investments, pension income, or Social Security. That 126,500,000 threshold applies only to self-employment income and wages, earned income, income that you're actively earning. I'm going to take a pause here and I'm going to jump over to talk what it looks like to work with Bright Tax. And I see questions continue to roll through, so I will work and answer all of those questions for all of you during the rest of the hour. I think we have another 35 minutes in the webinar, so I'll be working through those questions as they come in. I do want to stop and share, like I said, with you what it looks like to work with Bright Tax. We have a QR code here that you can leverage to register for our services. When you sign up and register for us, we start out reviewing your circumstances and your details to understand how we can help, to make sure that we can help with the tax filing exercise or provide professional consultation services. And our team will reach out and contact you to either coordinate a call or have an email conversation to give you a clear quote in engaging our services. So we can come back to the Q&A. The QR code remains here, so you can utilize that. If you already know that you could benefit from professional services, go ahead and use that QR code to register. All right, so jumping into the next question, Jeff asks, I will not be working, only Social Security and pension. Do I understand the foreign tax credit does not apply? So the foreign tax credit does apply. So that's where the foreign earned income exclusion has a limitation, but the foreign tax credit shines. If you have Social Security, retirement income, pension income, and you're being charged foreign tax on your income, we have the possibility to use the foreign tax credit to reduce your US tax bill. The actual logistics and details of how that is completed will depend actually on what country you live in and whether you're taxed there, whether there's a treaty in place that defines who has what's called the first right to taxation on those income sources. But the foreign tax credit at the high level does in fact apply to the income sources that you have described here. All right. I live in Mexico. I hold double nationality. My wife works for a company in the US and I work for a Mexican company. What is the best way to file? Great question. So in this case, I know that you have dual nationality. What I don't know is whether your wife also holds dual nationality. I'm going to make the assumption that you both have dual nationality, meaning you both have a US tax filing requirement. You as US tax filers, and assuming you both have citizenship and are having to file, joint filing is almost always going to be the best way to file. If your wife does not have US citizenship, married filing separately would be one filing status that's possible. If you have children, head of household could potentially apply to you as well. That will vary depending on whether you have children with US citizenship and their dependents and within a certain age. But with your wife working for a US company, that doesn't automatically mean she has to file US taxes. If she's not a US citizen and she works for a US company, she would only potentially be filing taxes if she spent time in the States at a chair and in a desk in the US and would have to file. But if she has US citizenship, then regardless of what companies you work for and where those companies are based, you're both going to need to file and report your worldwide income for those income sources. Okay. If I moved out of a US state with income tax, does the requirement for state filing go beyond just the year of moving out? So this varies. I won't necessarily speak to Georgia specifically in this case, but I'll talk high level about the fact that some states have a very straightforward requirement of if you spend this number of days in the state, you are considered a resident. And if you don't, you're non-resident. So if you moved out of a US state that you can easily cut ties with and end your residency with, you can file a part-year residency return to say to the state, I'm out of here. I'm no longer a state resident. You're not going to see a tax return from me next year. There could be some variations to that. Let's say you have a home in Georgia and you rent it out. In that case, you could potentially continue to file a non-resident tax return and report that rental income. But every state is different. I don't have the specific guidance for Georgia top of mind, but we would need to look into the Georgia state tax residency rules and determine whether your move effectively cuts ties with the state of Georgia, or if there are other things that you would need to consider when making that move. All right. The physical presence test is Gary's question here. How long did it take to qualify, and what is the process of change status? So when Gary refers to the physical presence test here, he's talking about the Foreign Earned Income Exclusion, Form 2555. And the physical presence test is such that if you have 330 days outside of the US during any 365-day period, you can exclude that 126,000 threshold of income from your US income tax, or from your taxable income. So in Gary's case, they've been abroad since November 1st, 2024. The period we're going to evaluate is November 1st, 2024 to November 1st, 2025. And as long as you've been abroad for 330 days in that window, then for November and December's earned income, you'll have the opportunity to exclude some of that income from your 2024 tax bill. And assuming you're abroad all of 2025, you can take advantage of that full $130,000 exclusion for the 2025 year. So with a physical presence test, 330 days is going to be your rule of thumb. There's not necessarily a process to change your status, but what we do is file the Form 2555 with your US tax return. In this case, you could potentially be doing that for both 2024 and future years. All right. So the next question I'm going to jump to is how to position yourself to avoid tax on US Social Security or pensions. Planning to spend 50% of the time in the EU and 50% in the US with dual citizenship. So the only way that you could potentially avoid US tax on these income sources is to establish residency under the terms of a tax treaty between the US and another country. So we would have to get very specific about where you're living, where you're establishing residency in the EU, and then drill down to look at the tax treaty between between the US and that country, and determine how the treaty decides where you're taxed on the US, and if the foreign country has the first right to taxation. So that would apply kind of generally anybody who lives in a treaty country. We would have to look at the treaty to see if it can apply in this circumstance. Okay. I worked in the US until October 2024. Then I moved to the UK and earned income for the last 2 months of 2024. Still there. What's the procedure for filing? So in a previous example, we talked through what it looks like to move abroad in November 1st. So this is not totally different than that case. But the difference here is that the person is moving to the UK. When somebody lives in the UK and they're paying tax in the UK, the tax bill abroad is almost certainly going to be higher than the tax bill in the US in most cases. In this case, when we're filing a tax return, we're usually going to take the foreign tax credit first. So what we're going to do is say, here's all of my income for 2024. Here's the tax bill for my UK income for the last couple of months. And usually by doing Form 1116, the foreign tax credit, we're going to eliminate double taxation and wipe out your tax bill in that case. So every country is different. So every circumstance is different. Somebody who lives in the UK may not have the same answer to this question as somebody who lives in a income tax-free country or somewhere where there's lower tax. So thanks for asking that follow-up. Okay. I created an entity in Uruguay to pay income tax I received from a US employer on the W-2. The entity is similar to individual entrepreneurship. Do I have to report the entity? Me and my family live in Uruguay. So the question you'll need to ask yourself and ask it to evaluate your entity is whether you have limited liability protection with respect to your Uruguayan entity. If the answer is yes, then we should probably look at the Form 5471 and see if that applies to you. If you don't, then it's possible that you have no foreign corporate disclosure requirement to look at, but I would recommend really taking a close look at that to make sure you don't have a potential to miss the 5471. That one has quite high penalties associated with it. So I would recommend a professional recommendation or a professional evaluation of whether the 5471 is necessary. Okay. I became self-employed in Hungary. How soon do I have to notify the IRS? I'm married filing jointly. Would I still file my taxes once a year? And would my wife be impacted by this change? Okay, so I'm going to make an assumption here that this person is a US citizen and you just moved to Hungary or you just became an earner in Hungary. When do I have to notify? So let's say I start earning income today, April 9th, 2025. I'm going to be responsible for reporting that income to the IRS next year. That'll be the first year. So next January, you can start the filing process, prepare your self-employment earnings, take any deductions, and file with the IRS, just like you would do if you were in the States. So in most cases, you can evaluate your tax filing requirement similarly to the requirement that you would have in the US. Okay. I live in France. The money in my French accounts is from my Social Security benefits to be paid to me here. All the money in the French accounts comes from the US originally. Do I have to file this information? You will need to file your bank accounts abroad, assuming that they've hit the $10,000 threshold. Any income that's being paid, so Social Security benefits will potentially be required to be reported on the US tax return if you have other income as well. On the French side, I would recommend connecting with a French tax accountant to understand what your requirements are there locally. We have a global network of professionals in other countries. France is one of them, so you can feel free to reach out to our team at hello@brighttax.com to request a referral if you're looking for a French accountant that we can be helpful in offering that introduction to. Okay, just sold a French home. So we have the French corner of the questions coming through right now. I'm concerned about capital gains because and moving money to the US. Currently in a British bank, minimizing or not increasing annual income is a concern. Owned the house more than 23 years, so therefore did not have to pay capital gains in France. Okay, well, the first question I would ask is, was this home your personal residence? If yes, then you have a 250,000 deduction of your capital gains, a rejection of your capital gains as a single filer. That increases to 500,000 if you're a joint filer. So that's the first thing to evaluate. If you are not subject to French capital gains, but end up being subject to US capital gains, the best way to minimize that is to make sure you have good records about your basis in that property. So the sale price minus the basis is going to be your potential gain, and that could be improvements over the years, etc. Overall, not having a large amount of annual income in that year is going to keep you in a lower potential tax bracket. Of course, I don't have the numbers of how much gain you have potentially here, but you could fall anywhere between 0 to 15 to 20% in terms of the gain if you are subject to tax on that gain on your French home sale. Okay, if I'm a UK citizen as well as US, do I have to disclose UK banking info? Yes, so holding a second passport does not exempt you from anything on the US side if you have a US passport. That's everything from income reporting to bank account reporting across the board. So we get that question a lot. It's quite common. You know, does my dual citizenship exempt me from anything? Does a treaty exempt me from anything? And generally speaking, the answer is no. Okay, Mike asks if Bright Tax can help with the foreign taxes. So Bright Tax specializes in US tax preparation, but Portugal is one place where we do have a strong global partner. We have a company on the Portuguese side that supports and works with our team to complete the tax returns in the most tax efficient way possible. In the order of when the tax returns are prepared, is it the US side first? Is the Portuguese side first? It depends on your income. And usually we would have that conversation with the Portuguese advisors to determine who can potentially take tax credits on the return and eliminate double taxation. And there, based on that conversation, we would decide which should get filed first. So this is a good question. Would it be easier to create an LLC in the US rather than be self-employed abroad? Creating an LLC in the US does not exempt you from self-employment tax, and it's not going to get around the 15.3 self-employment tax that we talked about. Creating an LLC in the US is actually just a legal structure. It doesn't impact your tax in any way unless you take additional steps to elect certain tax statuses for your LLC. All right. Nicholas asks if when am I considered a Spanish tax resident? Every country is different. We don't specialize in Spanish tax residency, so I can't unfortunately answer that question for you. But generally, 183 days is where many countries kind of set the trigger point of you becoming an official tax residency there. But you would definitely want to work with maybe a tax advisor in Spain or maybe an immigration specialist in Spain to help you understand at what point you become subject to Spanish taxes. Can I use the streamlined procedure to file only the last 3 years of returns if all my FBARs have been filed on time? This is a really good question. The big benefit of the streamlined procedure, which is the way you can get caught up to file your US returns if you haven't filed in some time, is the mitigation of penalties primarily on the FBARs, but also on the tax returns itself. So if you have been filing FBARs on time, the streamlined procedure may be helpful to you to reduce failure to file or payment penalties on the tax returns themselves. But generally speaking, the streamlined procedure is designed for people who failed to report foreign financial assets. Potentially, if you have the 8938 requirement for your tax returns, the streamlined procedure would be a very good way for you to get caught up as well as other international disclosures. So the ones we talked about, the 5471, the 3520, etc. So there are different approaches to filing if you've done maybe half of the exercise correctly and others not, but it'll depend, I think, on the ins and outs of your accounts and your income in those accounts abroad. Okay, I'm self-employed taking the foreign exclusion. For calculating my self-employment and estimated taxes, should I calculate the quarterly payments off my total expected income, or should I base it amounts above the foreign earned income exclusion? So if you are self-employed, at the high level, I would recommend calculating your self-employment tax across all of your income using the 15.3%. Estimated taxes can be calculated for the income tax portion on the amount above $126,500, or actually $130,000 for the 2025 year. But be sure to apply the highest tax or the high relevant tax bracket to the income above the foreign earned income exclusion. So when you are calculating the tax on the amount that's not excluded, the rate that applies is the higher end of the rate and not the lower end of the rate. So it doesn't kind of roll the clock back to zero, if you will, in terms of your tax rate. Okay. Let's see, a couple of other questions. Foreign tax credit related question. I live in Italy as a citizen and resident, also a US citizen, so we have a dual citizenship situation here. I have income in Canada, and interested in resourcing the US interests to Italy. What about the Canadian sourced interest? When I lived in the US, I paid tax on the Canadian sourced interest, but now we'll have to pay tax on that income to Italy. So we have 3 countries going on here. We have US, we have Canada, we have Italy. On the US return, any taxes you're paying in Canada, any taxes that you're paying in Italy are going to be able to reduce your bill. Regardless of how you're sourcing in Italy, the US treatment can be different than that. I think this is a very, very specific scenario. And of course, depends, as you know, on the foreign tax credit, as well as the treaty between the US and Canada, the US and Italy. But the tool on your US return is most likely to be the foreign tax credit. Okay, I have already filed my FBAR without realizing that an additional form may be required for the 8938. Should I file a second form or an 8938 or another corrective filing? I reside in the UK. So if you've already done an FBAR, you've made a good faith effort to do things right, to submit and declare your information. If you live in the UK, your filing threshold for 8938 is actually 200,000, not this 50,000. So you may still be in good shape, but if you have tripped the $200,000 threshold and do need an 8938, there are informational disclosure procedures that you can use to submit forms and in a penalty-free way, without having to refile everything. So I would explore informational disclosure procedures for international forms as a potential way to file the 8938 if it's necessary. An amendment in this case is likely to resolve that. Okay. U.S. tax treatment of redundancy severance payments. Those amounts are considered just like income, like a wage amount. So because it's tax-free in the UK, you would probably be using carryovers from the foreign tax credit from previous years to offset that income. So one of the big benefits of the foreign tax credit is the fact that when you have excess credits, you can carry them forward for up to a total of 10 years. So if this person has been living in the UK for many years and using the foreign tax credit throughout those years, there's potentially a foreign tax credit accumulating that can now be used to offset the tax related to the severance. So that's something that I would consider in the filing exercise for your return. Okay, I have foreign currencies like euro or francs in a US institution like WISE. Do I need to report those on the FBAR? So this is another example where I would say play it safe. WISE may or may not be a foreign bank account. I think it's kind of a gray area. The answer actually can depend on where the funds in the background are held. But this is a case where I would always recommend filing your FBAR. Doesn't hurt to disclose that information, and you're going to ensure you avoid penalties as much as possible in doing so. All right. If married filing jointly, does only one FBAR need to be filed? If so, does the FBAR include both of our social security numbers? This is a good one. So if married filing jointly, you may need one FBAR, but you may need your own FBARs. So in the case where you only have joint accounts, one spouse can file the FBAR and show that the accounts were joint, including the other spouse's social security number as the tax ID, and then the other spouse does not need to. That said, if there are accounts that are separate accounts, each of the spouses will need to file their own separate FBAR. Okay, is filing an 8938 FATCA, is there need to also file the FBAR? So the two forms are very, very similar. They're not exactly the same. As you know, they have different thresholds. We also file foreign financial assets that may not be on the FBAR in the 8938. So for example, if I hold stock in a foreign company, that may go on the 8938. My interest in a foreign trust, my interest in a foreign company, among other financial assets are disclosed on the 8938. So assuming you've met the threshold for both, you do need to file both. The 8938 goes to the IRS with your tax return, where the FBAR goes to the IRS. I'm sorry, the FBAR goes to the US Treasury. So they go different places, and they do carry a lot of the same information, but they are in fact both necessary. Okay, I live in India and pay taxes here. What is my filing threshold? Do I have to file an FBAR if I don't reach the filing threshold? So your filing threshold as somebody who lives in India is just the same, assuming you're a US citizen, as somebody who lives in the States. So the same threshold, applying that to your worldwide income is going to be relevant to you. The FBAR, if you don't reach the filing threshold of $10,000, you do not need to file an FBAR. So that wouldn't be necessary for you to submit. Is there a detailed book you could recommend for filing and non-resident taxes? So we can link in the chat. There is a filing guide that we have participated with a company, an organization called International Living to create on how to file U.S. taxes. And I think my team will put that in the chat. If you want, Gary, you could also reach out to us at hello@brighttax.com and we'll send you a link to that. But I also would encourage you to check out our blog, which isn't necessarily in a book format, but it contains thousands and thousands of pages of information that can guide you to filing your US taxes and answering the specific questions that you might have. So that would be a resource that I would encourage you to check out. Filing threshold for FBAR is $10,000. And that means that if you have $10,000 in accounts outside of the US, no matter how that's split up or divided between accounts, that is a disclosure that you will need to file each year. So $10,000, your key number there. If I live abroad and no longer own a home anywhere in the US, is it possible to be a resident of no state? Yes, it is possible, but it's not just a simple matter of not owning a home in the States. The definition of tax residency is different for every state, so we would want to look at the last state that you lived in the US and evaluate their definition of tax residency to determine whether you have to file a return there or not, or if you've effectively broken free, if you will, from the state filing requirement. All right, we're down to just a few questions. So if there are any left, feel free to continue to drop them in. We'll go right to the top of the hour here today. But I'll answer these final three to the best of my ability. So I'm a retired American in the UK, working part-time, self-employed. I don't have any complicated deductions or investments. Do I need to file a streamlined or a normal tax return? So you would need to file a streamlined tax return if you've failed to file up until now. So I'm assuming if you've filed every year, the streamlined procedure is absolutely not necessary. That procedure is very specifically for people who have failed to file in the past. If you've been filing every year, then keep doing that. I would always encourage electronic filing. Using the online systems is the best way with the IRS to ensure you get immediate confirmation. And you can file your tax return online. The streamlined procedure cannot be done online. It is a method that we follow, including a certification letter. There's a step-by-step approach that is prescribed by the IRS, and we follow and use that to ensure that we get this penalty-free treatment. And that does unfortunately have to go in the mail. But otherwise, a normal filing I would encourage it to be done in an electronic manner. How to structure a Canadian tax-free savings account to be sure it's easier to file and pay necessary taxes to the IRS. Well, the easy answer to that one, and there's really no easy answer here, is not having a Canadian tax-free savings account at all. So if you are a US taxpayer, the tax-free treatment of many foreign accounts, so there are accounts in the UK that are considered tax-free, there are accounts in Canada that are considered tax-free. Unfortunately, the IRS does not offer that same tax-free treatment of those accounts. So in those cases, we generally recommend avoiding those accounts in the first place. And another item that I'll mention, especially as it comes to accounts abroad, is that we strongly suggest understanding the implications of holding investments abroad, pooled investments, whether that be an ETF, a mutual fund, anything that's registered outside of the US has the potential to complicate your US tax situation very, very heavily. So in addition to types of accounts that exist abroad, it's really important to understand what you're putting into those accounts. Brokerage account and mutual funds are something to, I would say, proactively have a conversation with somebody who's versed in what's called PFICs, passive foreign investment companies, to ensure that you are aware of the filing requirements and the reporting burden of those accounts when you are setting them up. Okay. Retirement income from the US for a US citizen residing in Canada. If it's all sourced to Canada, there's been withholding to the US on the income, would the IRS refund that amount? So if you if you don't owe actually tax at the end of the day when you are calculating your US tax bill, the IRS is just going to refund that. And it is possible. So if you are a US taxpayer, you can arrange that withholding be modified on your US tax from the pension account, the retirement with distributions from that account. So that's something you should reach out to your broker and see, based on your status with the IRS or with the US, they can modify your withholding rates. Do you only help expats? This is a great question. So we help many, many, many expats, and we also help US-based taxpayers who have international circumstances. So we help people who live, I had a conversation with someone this morning in Colorado, but has accounts in the UK, or at some point worked in Australia, and so on and so forth. So lots of people who are foreign nationals moving into the States and having to file tax returns for the first time. We help people with international circumstances in general. That's where we really shine as a firm, and helping clients through the complications of those international disclosures. Okay, the process of renouncing U.S. citizenship. This one's becoming a more common question. The process of renouncing U.S. citizenship is actually a immigration-based process first and foremost. So it's a process where you go up to the embassy and turn in your passport. It does require on the U.S. tax side 5 years of compliance. So a lot of people say, I don't want to deal with this U.S. tax thing anymore. I'm going to give up my passport. But in order to do so, you have to prove that you, for the previous 5 years, have done everything by the books in terms of the IRS. So in addition to 5 years of compliance, there's also the potential for an exit tax, and that's something to think and talk about and evaluate before you make a very important decision like renouncing your U.S. passport. Something to proactively plan for and ensure you're not actually creating a big tax bill or a tax burden in making that decision. Okay, how many years back can the streamlined procedure be used? This is a great question. And traditionally, the streamlined procedure is used for 3 years, meaning if I were to file a streamlined procedure today, I would be filing 2023, 2022, and 2021 under the streamlined procedure because those are the 3 most recently past due returns. Later in the year, after June 15th, that focus is going to shift to be 2024, 2023, and 2022. And that said, if you have a particular reason that you want to include more than 3 returns, there are cases in which it makes sense to actually include 4 or 5 or 7 years. The key with the streamlined procedure is that the IRS cannot have contacted you first. So it's really important to be proactive and get ahead of the IRS. So it wouldn't make sense to include a year in which the IRS is already auditing you for or examining you for, which potentially would preclude you from using the streamlined procedure in the first place. Okay. When claiming foreign tax credit, do you have to include your foreign country tax proof of tax payment as attachments? The answer is no here, but you should always keep the proof in your records. So it makes sense to have a copy of your foreign tax return, the proof of the tax withholding, somewhere in your records, and probably hold those records for a good 6 years in the event that the IRS were to come back and request those. But it is not something you necessarily need to attach and file with your tax return. In fact, it probably wouldn't make sense to do that even if you do have them. Okay. Do I need to report my foreign group pension earnings? It's through my foreign job? Same question as earnings from a foreign credit union account. So let's start with the easy one. Earnings from a foreign credit union account, yes, that would be considered probably interest or dividends on your US tax return. So you would definitely be reporting that. Foreign group pension earnings is a little bit more of a unique question. I think the answer to this question depends on whether you have an account that's specifically designated to you, which I think the answer is no, based on the fact that it's a group pension. And so generally speaking, that one is not going to get reported on an FBAR because you don't have an interest in the account that pension is being grown within, unless there's a specific cash value that you can assign to that foreign financial interest. So it depends. I think we would need more information about that account to answer that question effectively. Okay. Is it okay to file the Foreign Earned Income Exclusion and claim bona fide residency at the federal level, but file as a resident in California? Yes, absolutely. California thinks so too. So we see many clients using these tools that we talked about to reduce their double taxation, whether it be the Foreign Earned Income Exclusion or the foreign tax credit, and they reduce their federal level bill, but then California doesn't necessarily recognize those and also wants them to file as a tax resident in the state of California. So ultimately, there are going to be discrepancies and variations between the federal level treatment and the state level treatment. Sometimes they speak to each other and it's to your benefit that they do, but you certainly can file as a resident and in many cases will continue to file as a resident in California, despite the fact that you live abroad. Okay, can paying double Can paying Social Security and Medicare be avoided when working in Uruguay on a U.S. employer W-2? I don't believe there is a totalization agreement in place between Uruguay and the U.S. I will have my team check me if I'm wrong, but I think I'm pretty confident that there is not. I know there's one in place for Chile, and I think one in place for Brazil, but I don't think Uruguay makes it onto the list of those South American countries with totalization agreement. If there were a totalization agreement, at that point, we would have the opportunity to potentially reduce your Social Security and Medicare tax. But in the absence of a totalization agreement, unfortunately, you're likely to be paying that 15.3. Well, at the employer level, it's half of that, and at the employee level, it's the other half of that. So about 7% in Social Security Medicare tax in your case. So I don't think that, unfortunately, that is possible. Okay. If I renounce U.S. citizenship, does my Social Security end? The answer is no. So these are different systems. Your U.S. citizenship and your Social Security benefits are not the same. So those should not be impacted. The only potential difference is the tax associated with your Social Security. There may be withholding taken directly from that. I know there are a couple of questions still lingering in the chat. hello@brighttax.com is the best way to reach out to us and get those questions answered. We'd love to have a conversation with you. Thank you so much for joining us today on the webinar, and we hope we have the opportunity to continue the conversation with you in the future. Thank you.